Hello and welcome back to this course on financial modeling. In the previous module section, we have discussed how do we make a choice between different value ideas that we may have. In a case study, we were evaluating a decision where to open the restaurant. I mean, selecting the restaurant. So we may have an idea to open a restaurant in a downtown market or a mall or a residential area, and we then evaluated how the revenue and the expenses in each of these are making a difference because of the way of the revenue selection between number of population, then ability to capture and ability to pay the market price, and how the costs are affected in each area, and how the cost of capital and the labor would affect in each area. So this way we could build a model to understand how would be the revenue and expenses for a year one or year two or year three. In the year one, for a choice or a location, we could have done a bit of more complex add a more complexity in here to see what is the future projection of future potential of different markets. However, in this model we did not factor that in. We can factor that in by adding the year one, year two, year three for each location, so that we can see over a period of time what are the potentials. So here, as we see, the better model of generating the revenue is either of these two. One is which is giving more profitability in terms of money, and which is one which is giving less profitable, but requires less investment as well. However, since when we normally make a decision, we are probably looking at where we can generate the more dollar values rather than where the percentage is more. So in this case, we selected the mall. Now, the next thing that we have to do here is that we have to create a business plan, because we may not have, as a case study, I'm going to teach you now how to make the business plans for future. Now, assuming that you may have an initial capital of only 10,000 and you will need another 50,000 in order to run the business. So the bank will ask you, or the startup founder will ask you, or the any investor will ask you, what is your business plan? How you are going to recover the money in next 5 years, 10 years down the line? How you will grow the business? So you may have to show that in the way of a model. So we may have strategies how we are going to do, what we are going to do in the first year, when we are going to increase the price, how would we increase the price, how would we capture the the guest or the permanent. But in order to make it a more effective story, what we want to do is we want to create a financial model to be able to tell the story with the numbers. So when you are telling the story that we will be increasing a capture ratio in, let's say, June, how would the number of guests would increase, how would the revenue would increase, what would be the impact? To model all those things, we need to create a model. So here is, I have started to create a model. Now you can see I have used the same basis as what we used to discuss in the previous model. That okay, we took the same things as we used to create in our previous module. The price of the club sandwich, we started with 295, more coffee 195, product mix we set 40/60 in the first month. Now here we have changed the slide. I will explain you how we have done it. And then we calculated what is the average spending per day by the customers. Now in this way, we have evaluated that, oh, why not we can try, we can increase the price in, let's say, year two, in the year one, in the May, and then we may be able to increase the price in year two. So basically you will see here, we are creating 12 months, month by month. In the previous model, we just did a 1 year because we were doing a feasibility study. Here we are creating a more detailed business plan. So normally in business plans, the first year is always detailed by month to for the 12 months. And then usually second year, third year, and fourth year is done by month instead of doing by the done by the year instead of doing by the month. Some may do it by month itself, but that is not practical because you cannot do a strategy by month for the next 5 years. You may be able to do foresee the next 12 months as max by the business prudence, but the second year, third year, fourth year, we normally just do by the year for the whole year, because you may have to start adjust your strategy every 6 months and every year, so there is no point on doing a strategy for next 5 years by month. You may do it by 5 years. So here is what the impact of the strategy is, that we may be increasing the price if of club sandwich in year two, and also the coffee in year two, and we may be also looking at a reversal of ratio by the product mix by from 40% to 50% in June, and as well as from the and to 60% in the October. Now, how you are going to do that? For that, you need to be able to write your strategies, right? Strategies. So here you are saying that I'm going to increase the price of coffee in June, in May. So why you should be able to increase the price? Maybe you want to change the coffee taste, you maybe want to change the presentation, you maybe want to change the way you are doing the coffee. So that's why that may give a reason for increase. So you may have to write that down in the strategy. And then you are going to increase the product mix of the club sandwich. So how you are going to do that? Are you going to upsell the club sandwich, or you are going to give some promotions? You are going to add the discount to the club sandwich? How you are going to achieve actually the higher proportion of the product mix? So this is something you may have to write down in your strategy, so that the investors or the bank or whoever is reviewing your business plan is able to understand what exactly you plan to do and how it would impact. So here you can see the impact is the average spending or average revenue per day from per customer is going to increase from 1.78 to 1.84 in May, when we are increasing the price of coffee, to 2.03 in June, when we are increasing the product mix proportions, and then 2.21 in the next years, and when we increase the price in year two, it will increase to 2.3. So that's how you will strategize and write down the strategies. Now, how much it will impact to the revenue, so that will we will see when we are doing the overall strategy or business plan for the next business plans. We normally have to create the target market first, customer acquisition. So here I'm following the same model as we created in our previous module. The residents, how much is the visitor daily visitors, and how much is the total available market. Then we took the audience capture, how much is the addressable market, then the current how much is the currently captured market, and how much market that we think from our existing capture to be able to capture, considering the competition. Here where the most exciting things happen, or the strategizing will happen, where you can say now that our capture ratio will increase by 12%. So how you are going to do that? Are you going to do any kind of marketing? What kind of marketing we will be doing? What kind of competition we are going to run? If you are going to impact the prices, let's say you're going to reduce the price, or you're going to increase the discount percentage, then we should go and factor that in our pricing strategy. So in April, when if we are going to increase our market share, and our strategy is to reduce the price, means giving higher discounts, then we may have to factor that in here and say, okay, maybe our achieved price would be only 275 and maybe zero point 0.9, right? That's the way that we can build it up. And then once our capture ratio has increased, then probably is again increasing in the June, in the October. to again to 15%, how you are going to do that? So means, are we going to have more digital marketing spend? So in this case, when we are doing the expense model, we will keep care in these months and show we are going to spend maybe a month earlier, so that we can substantiate how we are going to create how you are going to increase the capture ratio. Here again, we have modeled the for 12 months first individually, and then year 2, year 3, year 4. Uh, then visitors in the mall, because we are sitting in the mall, if let's say you say that the mall itself is expecting a 1% increase per month or 2% increase per month, you can factor that in by taking the visitors and multiply by the growth factor on a monthly basis. Another way is, if you say that the first, maybe the increase will not be consistent 2% over a year, maybe in the February, mall is saying that they will run some promotions, so the visitors will increase by 5%, and then it will only grow by 1% for the next 2 years, or next 2 3 months, and then it will be increased by another, let's say 3% or 4% in this months, and then another by another 5% because of or maybe 7% because of the season, the holiday season. Now this is increase, right? So what you gonna do is, instead of multiplying with the standard percentage, you can increase it by their individual percentage, and then you can follow the formula. So it will increase the daily visitors, monthly visitors. Now these are monthly visitors, not daily visitors anymore, to in the mall, and that will increase your total addressable market, total available market, total capturable market. And also, if your target is to increase this, and it will able to show how you are going to increase from 2000 customers a day is month, right? 2000 customers a month to to the 3921 customers a month. So that's then you will be able to explain it how you are going to do that, because any investor or any business person would ask how you're going to do it. So here you can say, on an average, you have 33,000 customers in a year, but year 2 it's increasing to 47,000. So here what we have done, here we have increased the market ratio itself to from 35% to 40%, right? The capturable market, because maybe we may want to increase our capture ratio, increasing the market size. So how you're going to do that? Are you going to launch a new product? So that strategy we have to build again. uh, we can build up another model, another product, or you may want to run a free campaign, or how you're going to capture the higher market share. You have to show in the models how, what are your assumptions, and how you are going to increase this capture ratio in the form of a marketing or a business strategy that will able to show the investors or the person who is going to review the financial model, so that they are clear how you are going to operate your business. The next thing what we have done here is, we assumed that now the maybe the business would change its model from the sale of food only to a subscription model as well. So in the initial time, maybe it's only sale of food, and 90% of revenue initially will come only from the sale of your transaction food. Maybe 10% will come from membership, or maybe in the few 3 months there is no subscription revenue, only the sale of food. And then you can build up a story that you will try to convert some of your customers into the membership, and the revenue percentage in these months, the membership revenue will grow from 0% as a contribution to 30% of total revenue, which means this is how much you're gonna spend. So transient customers are going to be this much, as we have modeled here, based on our total monthly customers and the percentage of revenue. So you can see continue to increase, but we are increasing the number of members as well. Now we have modeled average spend by the customers, average spend by, so which we have modeled in this previous model here. Then and how much membership we are going to charge from each member. So that will give us a revenue per month and ultimately a revenue for the whole year, so that we can understand it. And then in the next year, what we are going to do? Are we going to keep the same 65% increase and 65% subscription revenue, 35% subscription revenue, and 65% transient revenue? So that will increase our spending. Maybe we can increase it to 1.75 only. Maybe it's too much. And how our revenue will grow from 64,000 to 100,000 to 133,000 and 158,000. So here you can see the average growth percentage is 56% in year one, 37% in year two, 14% in year four, and then 1%. Usually the weak business models, what they would do, or financial models would do, they would consider only year one 64,000 and increase every year by 10%. But that is not justifiable, because you don't have a story behind it, you don't have a business plan behind it. Here now you have a business plan. You are telling the world that how you are going to increase your revenue per customer, how you are going to get more customers, right? So this is how you are going to build up the story behind your customer models and your business models. So that is on the revenue side. In the next, we're gonna discuss about the expenses.